Welcome back to Asia Insurance Review and this series of Fireside chats that we've organised with some of the global leaders of the insurance and reinsurance industry. I'm Paul McNamara. Today we're talking to Chris Way. He's Executive Chairman of Aviva Asia and Friends Provident International. And he's also Global Chairman of Aviva Digital. Chris has been in the industry for more than 2 decades now, during which time he's worked for AIA, AIG, Great Eastern, and some others. Chris is something of a role model for many young people entering the industry today, hoping to reach its higher ranks in Asia, but around the world. Today we're going to be talking to Chris about how he thinks the insurance sector is going to develop over the coming years. What main differences do you see likely to be in play in the near future based on what you can see happening now? And I thought it might be useful if we could kind of drill into it in parts. So, for instance, looking at distribution, how do you think distribution is likely to change? I say no specific end date in mind, but just over the next few years or 5 years.
Yeah, this is probably the question I get asked the most. More because of some of the things I've been involved in different countries and trying to rethink distribution. So my first comment would be, I think face-to-face advisory is definitely around to stay. It's just how that, channels or sub-channels will continue to evolve, leveraging digital technology. So actually some of the advisors that we work with, I know have taken the opportunity to leverage technology, whether it's Zoom, whether it's Teams, FaceTime, to sort of do advisory services digitally. And if you know your clients already, frankly, there's no real difference, except you save transport time and save money on a cup of coffee, right? You can be just as effective with technology in terms of delivering advice and explaining things, and sometimes even more so. But it does take some adjustment in approach. It means the advisor's got to learn how to be savvy in terms of using digital tools. Even something as basic as sharing a screen and doing a presentation on Zoom, you do have to go through a bit of learning. Sometimes the client has to figure out how to use that tech as well. So there'll be a period of adjustment. But that's such a linear comment to make. That's just at the very basic level. I think going forward, the economics of distribution have got to evolve. And in my personal view, and I state my bias on this, but I think sort of traditional bank insurance deals are probably going to need to evolve. I think insurance companies are getting increasingly frustrated with the amount of premium they're paying for bank distribution. And when you take that in combination with the fact that banks are actually investing in digital so that customers don't have to walk in a branch, that traditional banker face-to-face model begins to break down. And I think a lot of players that have paid a fair amount of premium in the past decade are going to rethink that. Is it worth it to pay the same amount for the next decade? Or how do I think about actually leveraging a trusted relationship with a bank so that the insurance journeys can be much more efficient? I think there's a lot of work and a lot of thinking being done in that area, and is going to be part of the evolution of distribution. And then finally, I actually think there is going to be continued disruption, and it's very much going to be in the players that understand the behavioral preferences and how customers choose to engage with their provider. So although, and recently there's been articles written about, what is next generation motor insurance going to be looking like with Tesla? What happens when you continue to progress towards autonomous driving? And that's just on the general insurance side. On the life and health side, insurance companies operate with really such little individual consumer data. We don't get a lot through the underwrite. We don't get a lot from doctors coming back when we pay a claim. When it's critical illness, we don't even have the details of that. We just pay a lump sum and really don't get a lot of detailed insight except for sort of high-level incidence rates. So new models will mean insurance companies are partnering with digital ecosystems, including medtech, health tech, to sort of really get some proper insight at an individual level. But that means building up data architecture and knowledge capabilities so that even learning how to capture that will be a bit of an uphill ride for most insurers that I'm aware of. So insurance companies will need to adapt. And all that kind of circles back around to that original question. How can insurance companies provide more insight so that advisory services actually add value? And if you can't, then it'll move digital. So I think that's sort of a long-winded way around of saying, yeah, there'll be a segment of the market that will always go face-to-face, but the truly exceptional insurance companies will be helping their advisors do a much better job than just doing a push sell of a term policy.
Yeah, actually, I remember a year or so ago at one of our events, at the Agents Awards, and the kind of winning agents were up on stage and saying, you know, I use Facebook and LinkedIn, and it wasn't just about kind of harvesting names. They weren't interested in that. It was getting to know the person on the other end and understanding the sorts of things they wanted, but more specifically, the sorts of overtures they would respond to when it came to trying to, you know, design a product and sell a product. And it was very much about that. It's not just sitting there aggregating a whole bunch of data. You need to understand it. You need to interrogate it and actually understand where. And I just wonder, you know, they say it's very easy to get someone to buy travel insurance on his phone as he's booking his flight, the days when you could fly. But medical life, maybe not. And it's a fascinating area. And obviously, if you were a traditional insurance agent in Asia, right now you're thinking about your future, not just your job, but, you know, 10 years, 15, 20 years from now. I
actually think it's a fantastic time for advisors to leverage the additional heightened awareness around health and concerns with medical products and so on.
Yeah.
And, you know, I don't think any of us expected a global pandemic a year and a half ago, right? But to your earlier point about Facebook, you know, if I'm a Manchester United fan and the advisor realizes that, you sit down and for the first time, it could be a virtual cup of coffee, and you break the ice talking about Manchester United. Advisory is the first step is building trust. The ability to break the ice in the first 15 minutes helps build that trust so that you can then have, because you've got some common interest now. Beyond that, you have an opening to talk about life. I think that's in itself a step in the right direction in terms of understanding your customer. It's about building relationships so that your customer is willing to share some of the more intimate details of what they're worried about. Yeah. That can lead to a productive conversation that can then lead to some proper advice being provided on insurance. So I'm absolutely a big fan of that. There's I mean, again, that's fairly basic, but really useful things to do in terms of building relationships and trust. Which
kind of sort of brings us on to the next question is really about how insurance companies might market themselves in the future. And it's not just using social media, but clearly that's part of it. But it's also around the areas of data privacy and so on and so on. But if you were you know, the marketing director of a significant size insurance outfit, what kind of things would you be strategizing around, do you think, in terms of how you go about promoting the brand, promoting the product, and so on and so on?
This is actually one of my favorite topics. And the first point I'll make is insurance is a non-passion category. So no one wakes up in the morning thinking about buying life insurance or cancer insurance, right? It's one of those things that you know you need, but you don't really want to think about. And this is very different to, you know, I'm passionate about art, or I'm passionate about wine or collecting watches, and that's different. People will naturally go and research, and it's an interest. So, you know, very few people are passionate about insurance, and therefore it's a harder thing to market. Second thing I'll say is, and this is, you know, I'm still the chairman of Blue Hong Kong. It's the first fully digital insurance company in Hong Kong. And the team did a great job sort of understanding purchase behavior. So the first thing to realize is people might shop on mobile, but they don't buy on mobile, at least in Hong Kong. In China, it's different. In Hong Kong, people want to sit down on a PC and buy. So you can't actually research your way to that. You can only test and learn your way to that. But the team figured out, you could be brilliant at programmatic retargeting, but if I'm getting the same content from one source, and again, it's a non-passion category. If I get constant messages back from that one source telling me I need to buy insurance, it doesn't work. Mm-hmm. It gets annoying really quickly. And that's the fundamental problem with insurance companies. It's typically a one-way outbound linear bit of communication with a message and expecting the customer to make a decision based on that. The reality is they don't. So the learning from Blue's activities is you need 50 to 70 touch points before someone is actually willing to sit down. It needs to come from a variety of different sources. When you work with key opinion leaders, i.e. influencers, there's a difference between a big one with 100,000 followers versus a small one with 200. The big one takes a long time making sure that their brand is on point. So it's an expensive video. You need to hire proper production crews. It's no different to sort of doing a TV commercial versus a small KOL, really difficult to work with because they're small, but they have actual real engagement and conversations with their followers. You need to work that funnel down. You need the awareness with the big KOLs all the way working down to the small ones that actually help you convert. That is a whole area of skill set that not many traditional insurance companies have in their marketing departments. That's a shift. The other thing to realize is everything I just described is unstructured data, right? Social media is unstructured data. So simple example, let's say I have the technology to record this phone call, and I've got the technology to convert the audio into transcript. That's still not really usable data. I then apply a natural processing language engine to pull out maybe highlights of wording that might be useful. I then need a rules engine to say, what did Paul and Chris actually talk about that I want to capture, and put into usable fields such that the customer service rep that picks up this file is going to know what this conversation was all about. Again, really complicated. There are tools that help streamline that, but I'm not aware of many insurance companies that are investing the technology to do that. So therefore, you've got an incomplete set of interaction capture, right? Versus a Lazada, an Alibaba, a Tencent that does this from the ground up. They've built the knowledge architecture to actually capture insights, and they know what to do with it. That's the difference between a digital native company and a traditional insurer trying to compete in that same space. Yeah. And it'll be interesting how this evolves. Some will say, no, insurance is too regulated. It's too complex, balance sheet heavy. The digital guys won't be able to compete with us in this space. It'll be interesting to see how this all evolves. And I think the insurance companies that embrace that there's a new way to capture insight and apply it to the insurance context will stay ahead of the curve. And finding the right way to invest sensibly to be able to do that in the right way is going to be the game changer.
Yeah, I know. I suspect you're absolutely right. I'm just wondering how many of the big insurance company groups have got head of marketing who's 50, 55, and not across all of this, because what you've described, I think, is actually a kind of replication of what used to happen in the real, like in the non-virtual world, but the speed at which you need to be able to do it, and as you say, the volumes of data that you have and making sense of it is the skill. I did an interview relatively recently with Bowtie in Hong Kong, and they were saying, look, everyone has to get data science. That's a given. You just don't even think about coming to us for a job unless you get it. And I suspect what you've just said is that goes all the way through into marketing as well. It's a new landscape, and you've got to understand it. So, kind of staying on that broad theme, but changing tack very slightly, is the next question really is about product design. And again, talking to some of these digital natives, they'll say we can conceive an idea and launch it in 7 days or 14 days or whatever, compared to 6 months or whatever it used to take. I wonder if you've any thoughts on where that's headed, maybe just in terms of timing, time to market, but also in terms of things like the need for ESG compliance and being seen to be green, or maybe not being seen to be green, but actually being green, and how you think that might impact on the whole area of product development.
Well, two very different topics there, so I'll address it in order. I think the first point you made is absolutely right. The speed of launch at low cost is game changing for an industry that thinks 6 months to launch a new product is quick. And the fundamental problem there is needing to implement those products through legacy systems. When you're dealing with a legacy product on a mainframe that already has 5 million lines of code, and you're putting in a tweak and you want to make sure that nothing else is being messed up in that 5 million lines of code, means you've got a huge amount of redundancy testing. Not particularly value add, by the way. But that's again, legacy drag, and a lot of the large incumbents have that drag. I think if I use like a Zhong'an, for example, the speed of rollout, because research only gets you so far, I think the digital natives are able to test and learn at speed and at a very efficient cost structure, such that they can iterate to a winner much quicker than a traditional player. That's actually the nuance behind the disruption, right? So I don't think anyone does testing or consumer research better than anybody else. It's just how quickly you can iterate to the winning solution. So I'm absolutely 100% convinced that's going to be the difference. In terms of ESG, which is a very different topic, I think you couldn't meet an asset manager and not have ESG as top of mind. There is the marketing pitch for ESG, and then there is the intent to actually do good for the earth. And the best ESG structures I've seen tend to link back to the UN frameworks, right? The sustainable global sustainable goals. And it's a fantastic way to kind of standardize the thinking behind ESG and investing in ethical companies. So I think I'm hoping that the industry doesn't just make it a gimmick. I think the industry controls a huge amount of assets that can legitimately do good for the world. Although I'm not so idealistic to say all of us must sell all of coal. If you operate in Poland, you have to invest in coal as kind of one of the fundamentals in the market. But you can certainly aim to influence capital markets so that actually the companies in which you invest are looking to do the right thing. So it doesn't help to be overly idealistic, but to really think about investing in the right companies that are going to leave the world in a better spot than when they found it. And there's multiple ways to think about that. It's not just about climate, but even diversity, making sure that if you're investing in a clothing manufacturing company, they don't use child labor in Cambodia, or do they have the right balance on their boards to advance kind of equality? There's a whole number of different dimensions to think about, which is why I kind of go back to the UN framework is a great way to think through that. How that directly translates to product is probably tougher to answer. But I think a great starting point is just insurance companies implementing within their asset management strategies some real awareness around ESG and again, making sure that the capital they control can influence the world in a good way is already fantastic.
So tell me, in terms of the kind of question of product development, I suppose what I'm thinking of is traditionally you would expect insurance companies sit around and say, we need to make money, we need to have products that we can sell to people. Where does the germ of the idea come from? Does it come from the insurance company sitting around imagining things, or is it because they listen to what customers are telling them, or they see market developments that make them think that there might be a product there they could, or sorry, a gap there that they could fill by developing a product? And if that process was the kind of traditional process, how has that been affected by the comments we've just been running over about ESG and green and doing the right thing, helping the planet survive a bit longer? And do those concerns come in? And if they do, where did they come in? Did they come in at the last minute, or did they come in very soon after the conversation about what are we going to sell begins?
That's a tough question, Paul. I would say the approach varies by company. So I'll answer in terms of my own personal philosophy. So I definitely am of the belief that companies that listen to their customers and understand the target market generally succeed better. There's a lower chance of failure because then you'd be manufacturing product that people want to buy, quite simply. So the next question is, how do you get that feedback loop? How do you get the insight? And there's no easy answer to this. I think traditionally, companies have used research companies. They, go with the likes of Bain and McKinsey to understand what the macro trends are. You can go with an Ipsos to do a particular research study for you and things like that. And that's helpful, in terms of evolving a set of products. Then you got to overlay sort of regulatory and national agendas on top. So if there's a particular, element of the healthcare system that, the Ministry of Health or the financial regulator is trying to manage, that's also very useful input. But in terms of game-changing stuff, right? I think, again, my belief is insurance products are way too complicated. Even when their government programs are a bit complicated. So you and I live in Singapore. If you buy a MediShield Life product, it's not the easiest to understand. And this is with strong involvement from the Ministry of Health itself and the CPF, which is the sort of the Provident Fund regulator, right? But as an insurance expert, I've read the wordings from my previous company as well as competitors, and it's quite difficult to understand. I think making insurance really easy, taking away the constraints, keeping it really flexible, and having consumers understand really what they're buying and the value that they're deriving from that product is critical. That means the communication style and the way the product descriptions work are shifting away quite dramatically from traditional legalese. So this is quite a shift in mindset for, I would say, traditional executives. There is actually technology that helps simplify language and will test the readability of contracts. And this goes back to building trust. What we sell ultimately is trust. So if you're selling a contract that people have a hard time understanding, and unfortunately, a lot of that means they either fully rely on an advisor or they only find out exactly what they're covered for when they try and claim, that's when trust is destroyed. And unfortunately, I would say that the trust metric of our industry doesn't do particularly well. So this, again, disruption of insurance means to rethink how products are structured, how they can be really tailored to individual circumstance, and how transparent they need to be. And I don't think it's contradictory to profit generation in terms of that transparency. I actually think the more transparent one is and customers are comfortable with what they bought, that ultimately leads to referral and cross-sell and loyalty, right? So sort of deviated off the question, Paul, but because I would say actually, and I'm glad this is a fireside chat, keeping it casual. It's harder to think how ESG factors into all of that, other than there will be a segment of the population that wants to buy a product that has clear ESG propositions behind it, because then they think their money is being put towards something that's better for the earth, if that makes sense.
No, absolutely. I mean, I think one of the curiosities of you talk to young people who are 25, 26, 27 these days, and they have absorbed a whole range of information about corporates that I certainly didn't consider when I was that age. And it basically hinges around things like ESG. And they will just not buy jeans made by certain companies or soft drinks made by, not because of any one thing, but just attitudinally they have picked up that these are bad people because of the sorts of things you touched on some minutes ago about, exploiting child labor in Cambodia or wherever it might be. And they're very conscious of that. And so if you have a company, and a good example might be Swiss Re, which is, very environmentally conscious in a whole raft of different ways, but doesn't do it quietly, quite rightly. It trumpets it quite loudly. And I kind of think to myself, that's very smart, because if you want the best graduates coming out of university going to work somewhere, you really don't want the insurance sector just to pick up the rats and mice that are left over. You want the creme de la creme. Mm-hmm. And they won't come unless they believe, because to go back 2 minutes to a comment you made about, the lack of trust in insurance goes back. One of my themes is, if you watch a movie from the 1930s or 40s or all the way up to current TV, the insurance guy is always a bad guy, without exception.
Yeah.
I think maybe DC or Marvel should do a whole series about a superhero guy who's an insurance agent or something. I really do. But Swiss Re, and I'm not championing them, but they've really gone to a great lot of effort to be seen to be doing the right thing, because they want good people working for them. Mm-hmm. And it's all part of this credibility, I think, is what you're talking about, is the position that insurance has to play in society, in our lives.
And I think that's a good thing, Paul. I mean, there's nothing wrong with trumpeting. Even if it's self-serving, I personally don't think there's anything wrong with trumpeting, because to your point, employers have to build their own brand as a good place to work. They want their clients to subscribe. And some of that is also influencing thought with their clients and their customers and other stakeholders. If you believe in what you're doing genuinely, I think that's actually really positive for the insurance ecosystem. Yeah, absolutely. To be sustainable, it has to be. Absolutely, absolutely. I'm not sure how that leads on to the next area, but critical for any insurer is pricing and how you go about, let's face it, it's not a charity. It's not there to, yes, we like to say that it helps people and it helps businesses and it helps companies and it helps individuals, but unless insurers make money from it, they just won't do it. So I wonder if you've any thoughts about how pricing will develop in future, both in terms of, the actuarial role itself, as well as sifting some of this data you were talking about a short time ago, and what impact does that have on pricing and how that might appeal to the customer or otherwise. Let me start off just to link that ESG point. The good news is, and I can speak for them because I think they have a sort of a public index out in the market. But Aviva Investors did some work and has, through their proprietary rules engine, proven that companies that do better on an ESG scale, i.e. they're more diverse, they're ethical, great governance, blah, 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 actually perform better. And that's good news, right? So ethical, well-managed companies that are diverse are also good investments. But getting on to the second bit, which is probably for me the bigger point, as a trained actuary, I would say insurance executives need to open up their minds to unconventional sources of insight. And probably over the last 5 years in my digital role, I've been surprised many times by the influence on pricing and underwriting from information that we wouldn't traditionally capture. And this is the intersection of behavioral data with finance and health data. So it goes back to, one very simple example I can give that the general insurance industry has been using for decades is credit. You wouldn't think about credit as, how does that influence my driving? It does a great deal. And it goes to behavior, because if you are, let's take the best case scenario. If you've got a poor credit score, you actually want to pay your bills, but you can't. That means you're just financially constrained. That means you'd rather put money towards putting food on the table or paying your child's school fees as opposed to changing the brakes and tires on your car when you need to. It's pure financial constraint, but it still means you're a worse risk. But actually, you'd be, as a responsible person, it doesn't mean you're not responsible. That's just circumstance. If you take the other side of the coin, which means you can afford to pay your bills, but you just don't, that's even worse. That actually means you're not responsible. When you're not responsible in paying your debt, you're not responsible in all other aspects of your life. And therefore, it's a great prediction of risk beyond car insurance. Actually, it applies to your entire financial profile. And we've seen metrics where if you are a better saver for your retirement, you're a better health risk, right? Blah, blah, blah. So, actuaries need to think, how do I get access to additional sources of information that will help me price and underwrite better? But I think it's not just about profit maximization. There's a lot of the marketplace that the insurance industry cannot respond to. Simple example, health insurance for people with pre-existing conditions. If you've got diabetes type 2, generally speaking, you can't buy more cover. If you've had one instance of cancer, you can't, buy more cover. The cruel irony of our product is when you need it most, you can't buy more. Right? But there are ways around that. If you have a way if you're type 2 diabetic and you've got the ability to monitor your blood glucose levels and manage your progression into chronic care, you can surcharge the customer, they probably pay. And that entire process is probably economic to sustain. But insurance companies need to move in that direction and rethink sort of who are they really responding to and what value they add to society. So I think that's a fascinating space. I think a lot will be happening in terms of continuing to broaden the product and services that can be delivered.
So just picking up on that, this area of I had someone speak recently on the question of kind of almost like bespoke insurance, and it comes to your point of if you've had one instance of cancer, you can't buy more cover, and this person was saying, look, the function of insurance is a pooling mechanism. You take 1 million people, they all pay in, some of them will have cancer. Therefore, if everyone paid, then you can afford to cover these people. But if you start tailoring it, you make it bespoke for that person, actually it ceases to be insurance and becomes prepayment. And I kind of think that's the point you're making here, is that there has to be a better way.
Well, I think there's a better way. So if you use retail as an example, and I'll use shoes. Traditionally, we buy shoes in half-size increments. But that's because, and even within there, you could have a lot of inefficiency in your retail system, right? So certain shoe stores, if they're very manual, won't know what styles are selling, what are not, which sizes they don't have. And I actually know from a shoe retailer that most of the time when they can't sell shoes, they don't have the right inventory in store. They don't have the right size, right? So technology can resolve that. If you had real-time inventory management, in your area of service, generally what colors and what shoe size sell best, you're going to make sure that inventory is in store. Okay, that's now you might go, well, what's that got to do with insurance? Well, if you have enough data, you can't do a customer of one. That I don't believe in. But let's say you're talking about Southeast Asia with a population of, easily 500 million people. If you can find 100,000 people that want a particular style of shoe and shoe size 7.25, and you have a way of making that group buy happen, right? And that group buy could happen on a Shopee or something like that. Then you could actually move to the next level of refinement. I'm not talking about a customer of one. Don't believe that. But there is a much better way to do things such that you can narrow the funnel from the conventional. You don't have to stick with a shoe size of half the size. So that's sort of what I'm getting at.
Yeah, excellent. Okay. Now the next kind of rough area I'd like to touch on is embedded insurance, and you kind of touched on this again a short while back, where you say people don't wake up this morning thinking, "Hey, I really need to buy some insurance today." And one of the thoughts I'd heard was that if you don't call it insurance, you just make it a 1.5% add-on to the cost of something, people will buy it. And the role of the insurer stays the same because it's still the same function, but the pricing of it and the selling of it and the marketing of it changes. I just wonder, have you any thoughts as to whether embedded insurance is a real thing? And if it is real, does it have a broad enough application outside of just things like TV sets or whatever it might be?
My first comment is I'm philosophically against it. Going back to the transparency point I made earlier, you don't build trust by embedding stuff when people don't know they have it, because half the time people don't claim and they paid for it. So it's a philosophical point and an ethical point. And it's been tried before. Right? In the UK, massive scandal with credit insurance. They embedded payment insurance into it. Customers didn't know they had it. And the insurance industry has been fined, and banks have been fined hundreds of millions of pounds because of that, and rightly so. So that's not helpful. If you then move to the next level of simplicity and you go, right, I bought something on Lazada or Alibaba and I get shipping insurance if I need to return the item, that's a bit better. But not when it's a negative option. When it's bundled in and people pay, 5 yuan and they go, okay. And again, I'm being a bit idealistic here. I think there's a way to do it so that, customers know what they're buying and they're willing to pay that $5 and say, yeah, there's value out there. Just in case I get the product and I don't like it, then I can ship it back for free, right? That's probably not embedding, but attachment at a very sort of clear level. So I guess in answer to you, my clear preference is to have a very obvious proposition that customers value and make it really simple and easy for them to understand and also buy. And that means your end-to-end distribution model's got to work. And understanding that different customers will have different preferences in terms of how they want to engage. So ultimately, I think going right back to your very first question, I think the future of distribution is omni-channel. It is some customers wanting to do little bits of things online. They may then have a question they might want to ask a call center or a live chat, or even a chat bot. And then it goes to, if I really need some help, I want face-to-face and I want to be able to actually meet somebody to go through a more complex problem or even to file a claim. That means, again, and I am going full circle on this conversation, that means insurance companies need to have the data infrastructure to capture all those bits of interaction such that omni-channel works. And it's really hard. And I'm not saying digital native companies have got this absolutely figured out. Frankly, I'm a big fan of Apple, but it's not easy to deal with them when you need to. Half the time you're going on to, Apple support that is actually serviced by volunteers, right? So I wouldn't say there's actually I can't even think of a fantastic example of omni-channel, but shifting in that direction and understanding customer empowerment with the right support, I think is going to be the way to go. It does ultimately, if we filter through all that, that I just mentioned, at the end of the day, having the right knowledge architecture and analytics capability is going to be what drives all that. Frankly, insurance companies can do that. they've got a lot of the foundational capability. They just got to continue evolving.
Which kind of brings me on to the next question, which is about competition for insurance from non-traditional sources. It might be Apple, it might be Amazon. And what I was thinking specifically about, I saw a presentation in Hong Kong a couple of years ago from the guy from WeSure. And he was saying, look, we do insurance, we sell insurance. We basically are brokers for other people's insurance. But the business model is data. WeChat ecosystem has games and gambling and messaging and you name it. And therefore we know people. And I can't remember how many millions of people they have. Therefore we could sell them shoes, we could sell them books, we could say, guess what, we're going to sell them insurance or resell insurance on behalf of other people on our terms. I just wonder, kind of what you, picking up on the theme from your last remarks there, this issue about data, the power of data, and whether those who have the data, Apple, Amazon, whoever, actually really pose a genuine threat to traditional insurers or even digital native insurers. And if they do, and this is the unfair bit of the question, are today's regulators capable of keeping up with what's required to regulate that sector efficiently and properly?
I think we're seeing the iteration of that with a lot of the regulatory hearings and things around big digital companies, even in the US. I think the advent of GDPR and PDPA and privacy regulations are good. It's probably, and personally, I believe it's really good because what it does is it puts the onus on the financial institution to come up with a proposition good enough such that customers are willing to share their data. So it's no longer assumed, right? You actually have to go and ask whether you want me to approach you again with something else, right? So I think that's a great thing because if I'm crap at service, you're going to say no. I've got to earn that right. And earning that right also links back to trust. So this is a good development. And again, the progressive companies that figure out how to come up with real value-added services are going to win. So do the big companies like Google and Apple have more insight? They do. Can they use it? Maybe not. So they can't get away from getting that marketing permission and making sure that they're adding value to their users. And even if they did, but they continue to feed crap, then at any point in time, customers can say, I'm taking that marketing permission away. You can't reach out to me again. So now that places some of the control back into the hands of the customer. The other significant development, and it's probably working a little faster in Singapore than maybe some other Asian markets, is not just open banking, but open insurance. And this is it significantly shifts the power of information from the financial institution back to the hands of the customer, because they can give access to their insurance holdings and their banking transactions to anyone that they authorize, which means the big insurance companies no longer have pure proprietary information about the coverage you bought. Now, this is going to significantly shift how financial planning takes place. I think, again, it's a very good thing because it will up the ante for companies to stay competitive and to remain, if nothing else, competitive on pricing. And that will be good for customers and good for building trust. So it's a number of things that are all happening. And sorry to be repetitive, but it does go back again to the ability to manage data and having the knowledge architecture and the analysis capability. So, if you think about the incumbents, moving in the cloud is hardened, right? Add 5G, 6G, 7G, and the ability to capture and analyze more information than we ever dreamed, even a decade ago, is going to be what's coming at us like a freight train.
Yeah, I kind of see that as if you remember a couple of years ago when InsurTech was hot and everyone was talking about it, and kind of as we've gone, to my mind, it's a rather like the start of the internet. If insurance companies haven't already got InsurTech embedded in it, then they're headed for the exit, because there is no future without adopting those kind of methodologies. And you're right, if you have data and you use it sensibly and you understand it, and you can actually draw meaningful conclusions from it to help you price, to help you develop products, to help you do the whole thing, then you'll be. But if you try and pretend that it's not happening, there's no way out. Chris, thank you very much for all of that. That has been absolutely fascinating. That's me covered for the next year of my editor's letters. Very, very grateful. Did you have anything you wanted to add in terms of your vision for the future of insurance that we haven't touched on?
No, not really. But I think Asia is the place to be still. I think we're seeing a bit of a shift in foreign capital, a little bit of exit. Having said that, certainly, we're seeing the rise of the local powerhouses, whether it's China or Thailand or certain markets. They're taking leadership positions, and that's been probably the shift of my career in terms of kind of a more dominant foreign insurer presence and shifting a bit local. But I am of the belief that this is still the most exciting place in the world for insurance. High growth, high population, growing middle class, and those with the right philosophy and mindset in terms of creating a new paradigm, I do think will outperform. So, looking forward to continue, hopefully playing a role in that.